This video is sponsored by Grammarly. Blink your eyes right now. A blink of an eye takes around 400 milliseconds, or 0.4 seconds. In that blink of an eye, in that 400 milliseconds, 240,000 stocks were traded on just these stock exchanges. Blink 240,000 shares, blink 240,000 shares, blink 240,000 shares. And guess what? The majority of these stock trades aren't even made by humans anymore. This is high-frequency trading.
You're working! Holy
One nanosecond faster, one clock cycle faster is all you need to be.
How a price changes, that's when the game is played. And when that one tick happens, the world is divided into winners and losers.
It's one of the things we have to realize. It's not our human world anymore. It's the world of the machines.
Yeah, high-frequency trading is just a segment of a much larger world, the world of algorithmic trading. It's a catch-all term to describe trading strategies whose success or failure solely rely on speed of execution or latency. Oftentimes when we're looking at a computer, we blink our eye, things are already gone. Speed of execution and latency is referring to the amount of time it takes for me to submit an order to the exchange and receive information from the exchange to me. And oftentimes when we're looking at high-frequency trading strategies, we're not dealing with seconds, milliseconds, or even microseconds, we're dealing with nanoseconds.
In the stock market right now, what you can picture is a bunch of algorithms that are basically programmed to hide, and a bunch of algorithms that are programmed to go find them and act. And all of that's great, and it's fine. And that's 70% of the United States stock market, 70% of the operating system formerly known as your pension, your mortgage. And what could go wrong?
If you're gonna start your own high-frequency trading firm, the hardest part is not the actual trading, but selling people on why they should give their money to you in the first place. That's where Grammarly comes in. The digital writing assistant I've been using for I can't remember how many years now. All you have to do is add the free Grammarly extension to your browser and boom, that's it. Now whenever you write an email, a Google Doc, which is what I use it for the most, or whatever else you write online, Grammarly's AI-powered writing assistant will help you effortlessly compose bold, clear, mistake-free writing, so you can focus on what matters, landing that investor, the employer, the viewer. All you have to do is hover over Grammarly suggestions, click on the suggestion, and you're done. And the best part, Grammarly is free, so you really have nothing to lose. But if you have big business goals, you might as well get the best of the best, Grammarly Premium, because it will pay for itself. You get the basic grammar, spelling, and punctuation corrections with a ton more. Vocabulary suggestions to replace boring bland words with more vibrant ones, clarity suggestions to cut down on unnecessary words, and tone suggestions to make sure the tone of your emails are professional and positive before hitting send. First impressions matter, and online, a lot of the time your writing is your first impression. So make your first impression count by pausing the video and going to grammarly.com/JakeTran to sign up for your free account. And get 20% off Grammarly Premium today. That's grammarly.com/JakeTran with the link below. May 6, 2010, the $1 trillion flash crash. On May 1st, 2010, Greece was drowning in debt and was on the verge of defaulting on that debt and going bankrupt. Greece needed a bailout, but to get a bailout, the people bailing them out would need to see that Greece is taking measures to make sure they have enough money to pay back the bailout. Or in other words, their creditors wanted to make sure that they weren't just throwing money into a sinking ship.
For Greek ministers, a day of humiliation. They turned up to be told the price their country would have to pay for a massive bailout by the EU and IMF.
Still, the Greek parliament announced massively unpopular austerity measures, a very inconspicuous term for cutting the fat off of government spending.
They will have to slash public spending and increase taxes. The Greek Prime Minister George Papandreou went on television and said big sacrifices would be needed from the Greek people.
Painful things that the people of Greece would have to pay for because of their government's reckless spending.
30 billion euros worth of cuts, public sector wages frozen, some pensions reduced, the tax on fuel and alcohol up 10%, VAT increased by 2%.
Greeks were not a fan of these proposed measures, so Greeks took to the streets. By May 6, the Greek parliament approved these nasty austerity measures in exchange for a $140 billion bailout by the European Union and International Monetary Fund. After that announcement, the protests and riots reached a boiling point. And everyone around the world, including those on Wall Street, was witnessing Greece falling into chaos right before their eyes, pushing the US stock market down.
There was riots on TV in Greece, and every time they showed the Greek riots, the market would drop a little.
There's a ton of trading activity in the US stock market, and by 12 p.m., the market was feeling extremely unstable. 1 p.m., an hour later, volatility in the stock market was so high that the New York Stock Exchange had to force trading to slow down. 1:33 to 2:25 p.m., a British stock trader working out of his parents' house in a working-class suburb in the UK grew sick of all these high-frequency trading firms that have grown to dominate the market over the years. So Navinder Sarao decided that this would be the day he would go up against them head-on. A David and Goliath type story, much like the recent Wall Street bets versus hedge fund debacle. So he starts spoofing the markets. See, these high-frequency trading firms use computer algorithms to trade. If this happens, do this. If a bunch of sell orders come in for a stock, it probably means that the price of that stock is about to go down. So, sell our shares, and so on. So what Sarao did was flood the market with a bunch of sell orders to trigger those algorithms from the HFT firms, causing them to sell. Their selling would trigger more selling from other firms, causing a self-reinforcing cycle downward, crashing the market. In coding, we call these infinite loops recursion, and before his sell orders go through, he would cancel them, leaving him unscathed. 2:30 p.m., 5 minutes later, volatility was up more than 20%, which is super high, and the market was headed downwards fast. 2:32 p.m., 2 minutes later, a big institutional investor, Waddell & Reed, initiated a giant sell order. But if they sold everything all at once, it would tank the price. So they used a trading algorithm to spread the sale apart, with one condition. If the volume of sell orders increased, it would speed up their selling since they would have less of an impact on the price. Pretty reasonable under normal conditions. This is pretty normal for institutional investors since they buy and sell in such large quantities. But today, that trading algorithm would only help set the stage for the most infamous flash crash, and the market continued to fall. 2:37 p.m., 5 minutes later, that giant sell order led to even more trading from others in the market, so much so that the data from the New York Stock Exchange got backed up, causing other exchanges to declare that they weren't able to get up-to-date data from them. 2:38:40 p.m., 1 minute 40 seconds later, the market starts falling faster, fear spreads through Wall Street, chatter explodes, screens start turning red. 2:42:40 p.m., 4 minutes later, the algos of high-frequency traders got triggered to start selling rapidly. Since they dominate the market, the number of buy orders start to dry up, while the number of sell orders explode, shooting prices down. The flash crash begins, panic ensues.
Wow! Almost 1,000 points! We call this a capitulation! They're gonna probably halt trading! We can't stop the selling!
And we're all just sitting there, and you're staring into oblivion. You're like, you have no idea what is about to happen. I was thinking that something terrible has just happened. Something indescribably horrible just happened. The market was gone.
You get a nauseous feeling. You're worried. You don't know, is the world coming to an end or what's happening, right?
2:46 p.m. The Dow Jones collapses around 9% and $1 trillion is wiped off the market, all in the span of around 3 minutes and 20 seconds. By 3 p.m., the market recovers most of that $1 trillion loss and things return back to normal. Over 2 billion shares were traded in the span of 20 minutes, worth around $56 billion. This event would later be known as the 2010 flash crash or the crash of 245. To this day, because of how complex the market has grown, we still don't know for sure what caused what.
And if you were to replay the same sequence of events identically, there's no guarantee that it would cause a flash crash again. That's the nature of complex systems.
But one thing is for sure, high-frequency traders played an instrumental role. How much do high-frequency traders contribute to these flash crashes and a general fragility of the markets?
Yeah, it's a good question. I'm glad you asked it. Flash crashes, in my professional opinion, are actually made less frequent due to the presence of high-frequency traders, or in other words, flash crashes are made more frequent by the absence of high-frequency traders. Now, there's a bunch of smarter people than me that did their own research into the CME. Researchers at the CME did their own research into what happened on May 6th, and they issued a report. And I'd like to quote you just a couple of sentences from there. There are people a lot smarter than me, and they came to the conclusion, and I quote, there is no visible support of the notion that algorithmic trading models deployed in the context of stock index futures traded on the CME group exchanges cause the market fluctuations in question, referring to May 6th. Furthermore, we find no evidence in CME stock index futures of any undue concentration of activity amongst algorithmic or any other types of traders. It's difficult to attribute the declining market action to any concentration of high-frequency traders. Rather, we suggest that HFTs may have had the effect of providing a buoyant function in the market. So what the CME here is actually saying is that HFTs actually acted as a shock absorber during a period where investors were dumping. Investors got taken control by animal spirits. They started panicking, they started selling, but algorithms couldn't feel that fear. So even when S&P E-mini futures were dumping, HFT algorithms were still jumping in and out, continuously quoting, and they were absorbing the shocks on the way down due to panic selling. So it's my opinion that, it's not only my opinion, it's backed by the CME's own internal report, that if HFTs weren't present in May 6th, then the flash crash would have actually been much worse than what it was.
What you may not know is that flash crashes like these aren't anything new. This one just happened to be a really bad one. From 2006 to 2011 alone, there were at least 18,520 of these. We'll call them ultra-fast black swan events. Over 18,000.
These crashes are not kind of things that just happen once in a while. They are the normal situation when algorithms get together. This ecosystem has optimized for speed, and as a result, they all end up looking pretty damn similar. And when you have a bunch of species that all look the same, you end up sometimes in catastrophe. It crashes. These things are not stable because they're not that smart.
Since 2011, high-frequency trading has only grown. August 18, 2011, 12.679 seconds after 12:08 p.m., Bloomberg releases this alert. Hewlett-Packard set to plan spin-off of PC business. Good news, if you saw that and you thought, I should buy some HP stock because it's probably gonna go up, you'd be correct. But you'd be too late because this is what happened in the next 4 seconds of that alert going out. The HFT algos do what's called sentiment analysis, where they scrape through press releases and websites to find certain keywords to quantify the general sentiment of something, sentiment analysis, and came to that conclusion and executed the trades orders of magnitude faster than you ever could. And you can bet that HFT firms are doing this right now in places like Wall Street Bets and StockTwits, which serves as a great segue into the limits of the human brain. It takes around 2 to 3 hours for a person to really consume a scientific journal. Going down that spectrum, it takes 5 to 10 minutes to consume the average news article, 3 to 10 seconds to read the average tweet, and then we get to the limit of human decision making, 1,000 milliseconds or 1 second. If you're an expert, that limit might go down to 650 milliseconds or 0.65 seconds. But anything beyond that is beyond the limit of how fast we can process information. This is where algorithms and high-frequency trading shines, where the only limit is how fast light can travel through fiber optic cables or through the air in the form of microwave towers connecting exchanges together. Where instead of thinking of trades in terms of years, months, days, hours, it's a game of milliseconds, even nanoseconds.
Just to give you a sense of what microseconds are, it takes you 500,000 microseconds just to click a mouse. But if you're a Wall Street algorithm and you're 5 microseconds behind, you're a loser.
By the time you've got to the first word in a story about a bomb exploding in Baghdad, the algorithm has already gone through and figured out the event. It's figured out the location, it's figured out the time, the intensity, it's put that into a model and it's traded oil futures before you've even had the page download. And this is the world where machines read the news and they know more about it than you do. But of course, if machines are reading it, they're probably also going to be writing it. And if they're going to write it, they'll probably also put noise out there just to confuse all the other machines. And you got to wonder, is this your world anymore? Or is it the world of the machines?
Let's say you're in Kansas and you want to buy a stock on the New York Stock Exchange. Let's say you want to buy GameStop at $10 to keep things simple. You submit your buy order in Kansas, that data gets sent to the New York Stock Exchange, and a bunch of sellers offer their selling price to you. The lowest selling price wins the order and that stock is sold to you. However, if I'm a high-frequency trader and I want to make money off of your order, all I have to do is get to your order before all the other sellers see it. I know you're looking to buy at $10, so I go to all the other sellers who haven't seen that there's another buyer at $10 because I'm faster than you, and I buy from them at $9.99, a cheaper price. And then I come back to you and sell it to you for $10, profiting 1 penny off of that arbitrage, that opportunity that only exists for fractions of a second. A penny may not sound like much, but remember, we're operating in the realm of computers. Computers that can find and perform these exact trades millions of times a day. A penny or even fractions of a penny per algo trade at 40 million trades per day equals $400,000 a day. And that's just from one example from a tiny firm 60 Minutes interviewed back in 2011. One can only imagine the profits bigger firms are raking in.
And their high-speed computers trade 40 million shares every day.
It's kind of like scalping, where you go to a concert, buy up all the tickets, and then sell them back to people who didn't get there in time at a higher price. Your thoughts?
Yeah, I wouldn't say HFT is like scalping at all, really. Scalping is based on technical analysis, as opposed to rigorous mathematical models generated by quantitative researchers that play with petabytes of data. With scalping, day traders try to make a very large amount of small trades in the hope that that will lead to larger profits. Now, while you hear the words large amount of small trades, you might think that those are characteristics in HFT. That is true, but like I said, the rhyme and reason is totally different.
Are there HFT firms that enter into these trades for nanoseconds to do scalping, or is it a longer time frame than that?
I wouldn't say that they enter to do scalping, because like I said, when I think of scalping, I think of like technical analysis. You buy a bunch of times and then you might lose a lot if you pick you buy the peak and then it falls and you're like, oh shit, all the profits I made on the way up scalping have been eliminated on the way down.
So when you look at it from this very lucrative angle, it's easy to imagine why HFT firms are dumping millions, maybe even billions of dollars just to squeeze out one more nanosecond, just one more millisecond. Why $300 million was spent to connect international exchanges together with a transatlantic fiber optic cable. Why they're switching from fiber optic cables to microwave towers because light travels faster through the air than through cables. Why HFT firms pay to have all their servers in the basement of the New York Stock Exchange to make sure everyone has the same fiber optic cable length to the exchange. Why HFT firms pay quants more than many doctors. Quants are the quantitative analysts who design these algos, because their entire business model revolves around just one thing: speed. And speed is a pay-to-play game. The underlying asset you're trading doesn't matter. It can be stocks, futures, currencies, commodities, whatever. Understanding economics, the fundamentals of a company also doesn't matter. The only thing that matters is outrunning the next guy to the front of the line.
What you need to understand is that high-frequency traders do not care about what the asset they're trading is. It can be dog shit for all they care. It can be Apple, it can be dog shit. It can be a banana, it can be Skittles. The only thing they care about is the price they see on the screen, because that price is subject to change, and all change leads to different opportunity.
So, you want to make big money as a high-frequency trader. You want to participate in the speed arbitrage. What exactly do these algos look like?
There's two generic strategies that quantitative trading firms may employ that come to mind. The first is called price arbitrage. So the day-to-day of a trading firm involves quoting tens of thousands, if not more, securities every day. And in doing so, they're generating theoretical values for dozens, if not hundreds, of option complexes. So that means that if the price of an option veers dramatically away from the firm's theoretical value, they will either buy or sell that option and push it towards its theoretical value, what they deem is correct. Now, when they buy or sell that option, they'll capture what's called edge, which is just a fancy word for profit. And they'll secure that edge by hedging out their newfound option exposure with the option's underlying futures contract. Now, capturing that edge via price arbitrage is an extremely competitive endeavor, often relying on speeds of several hundred nanoseconds. So the second strategy, and this is the last strategy that I feel comfortable publicly talking about, is called statistical arbitrage. Now, statistical arbitrage is sometimes referred to as stat arb. And it's a market neutral strategy that takes advantage of inefficiencies in pricing between correlated groups of securities. And to give you a little example, let's say we have Pepsi and Coke. And these are just two securities, but like I said, StatArb focuses on a group of securities. So Pepsi and Coke have a very strong correlation that has persisted over time as two competing companies. Now, if Pepsi and Coke are trading like this, and Pepsi's share price starts falling and becomes uncorrelated, untethered from that of Coke, then a trader will potentially buy Pepsi and sell Coke in anticipation that those two share prices eventually realign. Now, while this strategy has the word arbitrage in it, statistical arbitrage is a bit of a misnomer here, given that the strategy is not truly risk-free. So for example, if Pepsi, comes dislocated, but then it goes bankrupt, then the company would cease to exist, and any correlation that you previously discovered over a larger time period would prove useless. So the two strategies that come to mind, price arbitrage and stat arbitrage.
And these are just the well-known, easy-to-explain algorithms people know about. These HFT firms are always on the hunt for the next profitable algorithm and pay big money, enforced with very strong non-disclosure agreements for quants to design them. High-frequency trading is shrouded in mystery and has only recently come into the spotlight a little bit. One huge benefit that HFT has provided for the markets is liquidity, meaning that whenever you want to buy or sell a stock, there's always a buyer or seller right there ready to go, unlike something like physical real estate. The spread between what the price buyers and sellers are asking for have also gone dramatically down thanks to HFTs.
Yeah, they lead to, like you said, lower bid-ask spreads, which saves retail traders maybe only pennies on the order. And on the surface, you might ask yourself, who cares about pennies? But in the grand scheme of things, that saves retail traders billions of dollars annually.
Do you think there's a big opportunity cost where we're employing like some of the smartest minds in math to make a few cents per trade when they could be doing something in regards to like space or something? What do you think?
I thought of this a bit. I don't think so. For starters, I'm kind of like more of a live and let live type person. I don't think other people have a role in telling you what to do with your life. If somebody wants to be a writer, write. If you want to paint. It's as simple as that for me. But going beyond that to the actual tangible implications of a mathematician working on a quant research desk as opposed to, a spaceship, I think that HFT still has a very tangible impact on the world, and their contribution would be useful in high frequency trading. High frequency trading, or the impact of it, stretches beyond financial markets. For example, let's say there's a new company that wants to go public. Now, they rely on quantitative trading firms to market make for their IPO. The reason being is, if investors don't have confidence that there's a market, that there are participants, that they can sell their shares publicly after the IPO, then they'll be less inclined to subscribe to that IPO. And if they're less inclined to subscribe to a given company's share issuance, that company can't raise money. And if they can't raise their desired sums of investment, then they can't produce products and services that at the end of the day benefit people like me and you, consumers. So if they can't produce those things, nothing new happens, there's no innovation, and our living standards just tend to stagnate.
In your opinion, is high frequency trading fair?
In terms of, is high frequency trading fair? I think that's a difficult question to answer, because fair is an extremely subjective word that's shaped by our own worldviews and influenced by our upbringings. I like to flip the question a little and ask, is HFT unfair? Now, when I think of unfair, I think that somebody is either being coerced into some sort of transaction, or one party has some sort of inherent advantage or systematic advantage conferred to it by some partial arbiter. And that is not the case in high frequency trading. In high frequency trading, your ability to turn a profit is directly correlated to the talent that you can hire and the amount of capital that you have on your disposal. There's nobody stopping you or anybody else from starting your own high frequency trading firm. So when two parties enter into a transaction, it's entirely voluntary. Whether the party on the other end is an algorithm or a Redditor, it really doesn't matter, and it shouldn't matter. So to answer your question, is high frequency trading fair? Based off my professional evaluation, I would say it is fair.
Okay, and your reasoning is because it's not like the government is giving you guys some inherent advantage over retail investors. Anyone can buy the computers, hire the developers and quants and researchers, etc., and do the same thing you guys are doing. So pretty much like a free market.
That's exactly it. And the exchanges don't confer some sort of privilege on us. All the information regarding market makers is public online. All the information regarding how market data is disseminated is public online. There's no fast track because you are a high frequency trading firm. We get treated the same as everybody else.
Okay, makes sense. Ooh, new hair, new jacket, and no, I do not watch anime or listen to K-pop. I just really like the style, and you guys can let me know what you guys think of it in the comments below. If you want to support this channel financially, you can check out Grammarly with the link below. Again, I've been using Grammarly for years now, way before YouTube became a thing, and I really enjoy using it pretty much like every day. You can create your free account at grammarly.com/JakeTran, and you can also get 20% off Grammarly Premium with the link below. Coding Jesus, the guy you saw sprinkled throughout this video, he is a quantitative developer, meaning that he's the one that actually writes the code that runs these high frequency trading algorithms among other algorithms for trading in the markets. He does that full time, and he has a YouTube channel that goes over this stuff, and it really helped me out with researching this video. And he has like really clear explanations that are still technical but are easy enough to understand for the average person. I highly recommend you guys check out the full interview we did on the second channel with the link below, where we go over what it's like being a quantitative developer, what the difference between a quant developer versus a quant researcher versus a quant trader, and you can hear his full explanations on his opinions, which I think are really rational and really reasonable too. And you can also check out his YouTube channel with the link below too. If you are new to this channel, we make video essays just like this one every single week on the most thought-provoking stuff in the world of business, just like this video, and it's free, so you can dislike and unsubscribe and leave me your best hate comments whenever you want, so you might as well click that subscribe button with the red button below because you have nothing to lose and everything to gain. Other than that, you can follow me on Instagram at jaketrend.io, where we go over behind the scenes stuff, day in the life kind of stuff, many business memes that I really enjoy. jaketrend.io. That is gonna wrap it up for this video. Thank you so much for watching. You've been awesome. I've been Jake. Stay dangerous out there, and I will see you guys in the next one.